So today, we're diving into a company called The Assembly Place, or TAP for short. They're a really big name in Singapore's co-living scene, and they've just hit the stock market and dropped their very first financial results. So what's the story here? What are these first numbers telling us about the company? Let's break it all down from an investor's perspective.
Wow, okay. Let's just kick things off with the headline number, shall we? A 42.4% jump in revenue for their 2025 fiscal year. I mean, right out of the gate, a number like that, it definitely grabs your attention and really sets a positive tone for their public debut.
All right, Section 1, TAP's strong maiden results. Let's dig in and take a closer look at the key financial highlights for the 2025 fiscal year. We're going to see what's really going on under the hood here.
And here's what that growth actually looks like. I mean, just look at this jump. We're talking about going from 17.7 million Singapore dollars to a whopping 27 million in just 1 year. This isn't just a little step up, it's a massive leap, and it's basically screaming that there's some serious market demand for what they're doing.
Okay, now to really get a handle on their profitability, we got to talk about this one metric, adjusted NPAT. Now, it sounds a bit technical, but it's actually super simple. It's just their regular profit, but with the one-time $1.1 million cost of their IPO taken out. For an investor, this is what really matters, because it cuts out the noise and shows you how the actual day-to-day business is performing.
And this number really shows their strength. That adjusted NPAT grew by a super healthy 24.2%, hitting $7.7 million. So this tells you it's not just that sales are booming, their actual fundamental profitability is growing right there with it. That's a great sign.
So the big question is, how are they doing it? How are they pulling off these kinds of numbers? Well, the secret lies in their business model. Let's move on to Section 2. What is community living? We're going to unpack what makes these guys tick.
First things first, you need to understand their position in the market. TAP isn't just some small-time rental company. No, they are Singapore's largest community living operator. We're talking over 3,400 keys, which is just a fancy way of saying rooms, under their management. So yeah, they are a major player.
Their whole business really stands on 3 legs. The main one is community-driven stays. That's their bread and butter. Then they have other property-related services, which are basically value adds. And finally, and this is pretty smart, they have an investments arm where they buy small stakes in the companies that own the properties. It gives them some skin in the game.
And this right here, this is their secret sauce. See, their whole thing is that they aren't just giving you a room. They're trying to build a real community. They're organizing workshops, hikes, parties, all sorts of shared experiences. In a really crowded rental market, that focus on community is what really makes them stand out.
Now, from an investor's point of view, this next part is absolutely crucial. TAP uses what's called an asset-light model. What that means is they don't buy the buildings themselves, they just manage them for the owners. Why is that so important? Well, it means they can grow incredibly fast without having to take on massive amounts of debt to buy real estate. It's a key reason they can scale up so quickly.
Okay, so we've got a solid business model, but let's look at the engine room. What are the 2 main things that are really driving this financial growth? Let's jump into Section 3, the growth engine explained.
The first one is pretty simple. It's just the number of keys they manage. They grew from just over 2,100 keys to over 3,400 in a single year. More keys directly translates to more revenue, right? So this massive expansion is the main engine behind that 42% revenue jump we saw earlier.
Of course, adding a bunch of rooms is only half the story. You have to actually fill them. And check this out, their average occupancy rate is 94.4%. That is an incredibly high number, and it proves that they're not just growing, they're growing efficiently. The demand is definitely there.
So, their past performance? Super impressive. But as investors, we're always looking down the road. So let's shift gears and look at the future. With Section 4, the road to 10,000 keys. And let me tell you, their plans are not small. The CEO, Eugene Lim, has set a really bold target, reaching 10,000 keys under management by the year 2030. That's almost triple their current size, which lays out a very clear, very ambitious roadmap for the future.
So how are they going to get there? Well, it's not just a dream. They already have a concrete pipeline. They've already secured almost 1,500 new keys, and they're diversifying into new areas like hotels, even housing for migrant workers. On top of all that, they're taking their first step outside of Singapore with a new property in Kuala Lumpur. The foundation is already being laid. And crucially, it seems like the market itself is on their side. You've got all these trends, people moving around for work, the crazy high cost of buying a home in Singapore, and a younger generation that just prefers flexible leases. It all creates kind of a perfect storm of demand for what TAP is offering. These aren't short-term fads, they're long-term tailwinds for the business.
Okay, we've looked at the performance, the business model, the future plans. Let's try to bring it all together now in our last section. Section 5, Investor Outlook and Takeaways. What should you be thinking about?
Now, before we get to the good stuff, it's important to remember what the company itself says. All these future plans are what they call forward-looking statements. This is standard corporate speak, but it's a really good reminder that targets aren't guarantees. There are always risks involved in any business plan. So, with that little dose of reality in mind, what's the key takeaway for an investor looking at this company making its public debut? I think it really comes down to these 4 things. 1, they've shown strong, real growth in both revenue and, most importantly, core profit. 2, their asset-light model is super scalable and smart. 3, they have a clear, ambitious plan for the future that they're already working on. And finally, 4, they're riding some powerful, long-term market trends that are working in their favor.
This content is intended to serve strictly and only as an informational, independent, objective summary of recent events and should in no way be interpreted, construed, or relied upon by any party as inside information or financial advice.